Imagine a world where merchants traveled thousands of miles, carrying nothing but promises on parchment, and empires rose or fell on their ability to finance it all. Welcome back to Historical Finance, the channel where we explore the untold stories of money, credit, and trade that shaped the world. Today, we dive deep into the history of global trade finance, from Mesopotamia to Venice, from the Silk Road to the financial hubs of Amsterdam and London, and onward to modern banking. Trade finance wasn't just about moving goods. It determined who could conquer, who could rise to wealth, and who would fall into ruin. In this video, we'll uncover the mechanisms, strategies, and human ingenuity that powered centuries of commerce. Our story begins long before banks, stock exchanges, or even coins. Ancient civilizations needed a way to finance trade. In Mesopotamia, clay tablets recorded transactions and debts, functioning as proto-banking instruments. Temples and palaces acted as early banks, storing grain, silver, and precious metals while issuing loans to merchants. In Egypt, merchants used promissory notes to secure payments along trade routes, and scribes meticulously tracked debts and repayments. Without these early instruments, long-distance trade would have been nearly impossible. Credit, trust, and documentation, the very foundations of modern finance, were already in place thousands of years ago. By the Middle Ages, Venice had become the epicenter of Mediterranean trade. Venetian merchants didn't just sell goods, they engineered finance itself. Bills of exchange allowed merchants to transfer payments safely without moving gold. Insurance pools spread the risk of shipwrecks and piracy, a precursor to modern insurance. Letters of credit provided proof of funds abroad, enabling safer trade. Venetian merchants leveraged these tools to gain influence over governments, diplomacy, and even wars. The famous Medici family of Florence started as bankers, financing trade, wars, and even the papacy, showing the inseparable link between finance, trade, and power. Mastery of trade finance allowed merchants to scale operations far beyond their own capital. While Venice dominated Europe, the Silk Road connected continents. Merchants traveled thousands of miles, often never carrying cash. Instead, they relied on merchant credit, which took the form of transferable certificates representing deposited goods or funds. Risk management was essential. Caravans pooled resources to share the loss of goods. Currency conversion required complex bookkeeping for multiple currencies. The Mongol Empire's stabilization of trade routes dramatically reduced transaction costs, allowing credit to flourish and trade volume to surge. Trade finance is ancient globalization. Principles of trust, risk management, and credit have always driven global commerce. The 17th century saw a financial revolution in Europe. Amsterdam and London became global finance hubs. Joint stock companies allowed investors to share risk and profit, creating the first modern corporations. Structured marine insurance protected merchants' investments. Governments issued bonds to finance trade and wars, formalizing financial instruments. The Dutch East India Company issued shares worldwide, allowing investors to spread risk. London's Bank of England extended trade finance further, with government-backed loans, stabilizing currency, and enabling large-scale trade. Trade finance enabled the industrial and colonial expansions of Europe. Shares, bonds, and insurance are their legacy. Centuries of trade finance reveal timeless principles. Trust is currency. Letters of credit formalize trust between merchants. Risk management is essential. Pooling, insurance, and diversification are ancient practices. Innovation drives trade. Bills of exchange, joint stock companies, and bonds expanded commerce. Finance shapes power. Control of finance often determined global influence. Venetian merchants, Medici bankers, and VOC investors all leveraged finance to gain power, wealth, and influence. By the 19th century, trade had expanded globally. Industrialization, colonial expansion, and steamships transformed commerce. Letters of credit became standardized instruments, allowing merchants to operate across continents without carrying physical currency. Insurance evolved. Lloyd's of London formalized marine insurance, creating sophisticated actuarial assessments and risk distribution. Nations stabilized currencies with the gold standard, reducing exchange rate risks. British and French banks financed colonial ventures in India, Africa, and the Americas. Merchants could now buy, ship, and sell goods worldwide, leveraging structured credit systems. The 19th century transformed trade finance from merchant-led solutions into formal institutional systems, the foundation of modern international trade. History teaches that innovation alone is not enough. Financial systems are fragile. Tulip Mania in the 1630s in the Netherlands showed how over-leveraging and speculative bubbles can ruin traders. The South Sea Bubble of 1720 in England demonstrated the dangers of over-promising returns, and late 19th century trade failures illustrated how overextension of credit to colonies and failed shipping ventures could stress entire banking systems. Trade finance succeeds when risk is distributed, transparency exists, and instruments are properly regulated. Historical collapses shaped banking regulations and investment strategies for centuries. Trade finance evolved differently across civilizations. In China, merchant guilds and private banks, called piaohao, managed domestic and international trade, with letters of exchange allowing long-distance commerce. In India, banking networks financed textile exports and colonial trade, integrating local markets into global commerce. In the Middle East, caravanserais doubled as credit hubs, and Islamic trade laws formalized risk-sharing mechanisms. In Europe, Amsterdam, London, and later Paris became hubs for formal banking, insurance, and bond markets. While tools varied, letters of credit, insurance, or bonds, the principles of trust, risk management, and innovation remained universal. The 20th century marked the institutionalization of trade finance. Banks specialized, creating departments dedicated to export-import finance. Global payment systems like SWIFT, letters of credit, and correspondent banking allowed instant cross-border transactions. Governments imposed regulations, capital requirements, deposit insurance, and lending standards to stabilize markets. During World War I and II, trade finance enabled nations to import critical resources despite logistical chaos, showing the strategic role of finance in national survival. Modern trade finance is the culmination of millennia of innovation, risk-sharing, and institutional learning. History provides timeless guidance. Credit is trust. Without formalized trust, trade collapses. Risk management is crucial. Diversification, insurance, and pooling remain essential. Innovation expands possibilities. Each financial breakthrough, from bills of exchange to SWIFT, enabled greater trade capacity. Finance shapes societies. Economic power and political influence often follow those controlling credit systems. From Venetian merchants to global banks, the story is clear. Those who understand trade finance can influence empires, economies, and the course of history itself. Trade finance is not just a modern invention, it is the invisible engine of human progress. Across deserts, oceans, and continents, credit and risk management have determined who prospers and who fails. By studying these lessons, we not only understand history, we gain insights into the principles that govern wealth and power even today. Thanks for watching Historical Finance. If you enjoyed this journey through centuries of trade and finance, make sure to subscribe and hit the bell to explore more untold stories of money, credit, and power.